Hello, everybody. Welcome to Intermediate Accounting 17th edition video solution walkthrough for Keystone, Weingarten, and Warfield, exercises 1626, 1627, and 1628. The questions used in this presentation are copyright 2019 by John Wiley and Sons. All rights are reserved for educational purposes only. This video may not be distributed or redistributed without the express permission of Wiley. This solution presentation is copyright 2019 to 2021 by Bennett Tchaikovsky. All rights are reserved. The opinions contained within this presentation are those of Bennett Tchaikovsky and not the authors or Bennett's employers or likewise. Okay, so let's go ahead and get going here. Okay, so let's take a look at our first question right over here. And let's clear all this fun stuff out and start fresh. Okay, so Venezuela's company net income for 2020 is 50,000. The only potentially dilutive securities outstanding were 1,000 options issued during 2019. Each exercisable for one share at $6. None have been exercised. And 10,000 shares of common were outstanding in 2020. The average market price of Venezuela stock during 2020 was 20 bucks per share. Okay, so the way that I'm going to go through and show you how to kind of go through and do these is that the first question is, are the options in the money? And what do we mean by that? It means that the exercise price of $6 is less than the market price of 20. So these options are in the money. If they're in the money, meaning that a normal person would go ahead and exercise these options, they are going to be dilutive. So the first thing that we're going to go through and do is say, okay, if we were to go through and exercise these options, how much money would the person make? So you've got the number of options, which is 1,000. The market price, let's do it this way. We'll say options, market price per share. And my market price per share right over here is at 20. So the total value right over here is going to be 1,000 times $20 per share. Right? So this is basically what the value of these options are right now. Now, if these are the value of the options, this is not free. Why is it? Is because I have to adjust this. I'm going to have 1,000 options. My strike price per share is $6 per share. So over here, I'm going to have a total of $6,000. That's going to be my cost. So basically, this is the current value of the options, and this is the cost of the options. So basically, I would call this like the profit of these options is going to be $14,000. Okay, now, this is kind of what we would go through and call something called like a cashless exercise, meaning that you get the options without paying for any cash. So instead of giving them a check for $6,000, basically we're going to turn around and they're going to give us 14,000, or basically the current market value of the options. What is the current market value of the options? Well, if my strike price is at 6, market's at 20, it's going to be $14 per share, or 14,000. Okay. So when it comes to going over here and computing diluted, or basically if on my EPS, right? So I'm being asked to do diluted earnings per share. So what is diluted earnings per share? This is going to be my net income, right? Minus any preferred dividends, which is not present here, divided by my weighted average common shares outstanding, plus any dilutive shares. Okay, we already said that this is dilutive because these options are in the money. So my net income right over here is $50,000. The weighted average common shares outstanding is 10,000. Now, if I'm looking at this over here, what I want to do now that I figure out what my profit is, I'm going to go ahead and take this profit and I'm going to divide this by the market cost per share, or the market price. What this is going to tell me is that how many shares that this is in fact going to go through and dilute by. So over here, if I take 14,000 by 20, I'm going to get a total of 700 shares. Okay, right? Why is it not the 1,000? Well, if we were to go through and use what we call a cashless exercise, I would just give the person 700 shares. It's essentially the same effect as them giving me 6,000 bucks, turning around and selling it for 20,000, basically making 14,000. How many shares does that represent? 14,000 divided by $20 per share is going to be 700. So over here, I'm going to be dividing this 50,000 by 10,700. So my fully diluted earnings per share for this particular example is going to be $4.67. So that is my first part over here, which is part A, compute diluted earnings per share. Okay, let's go to this next one. Assume the same facts for those in part A, except that the options were issued in 2020, right? There was an implicit understanding with these 700 shares is that these were outstanding for the entire year, right? But if we're now going to say that these are only outstanding, so this is part A. If for part B, right, if they're only going to be outstanding basically for part of the year, right, this 700 assumes they were outstanding for the entire year. So if it's only outstanding from October 1st through December 31st, I then need to multiply these 700 shares from 10/1/20 to 12/31/20. This is 3/12. If I multiply this by 3/12, I'm going to get a total of 175 shares. So right over here for this particular example, I'm now going to have 10,000 plus 175, 10,000, 175, 50,000. I divide this through and I'm going to get roughly $4.91. Okay. So again, when it comes to figuring out the dilutive shares, we have to be very mindful of how long these are actually outstanding for. Okay, now this next one over here kind of gave me a little bit of thoughts to kind of go through and think about. So Windsor Inc. recently purchased Holidays Corp, a large Midwestern home builder. A large Midwestern home painting corporation. One of the terms of the merger was that if Holiday's income for 2020 was 110,000 or more, 10,000 additional shares would be issued to Holiday stockholders in 2021. Holiday's income for 2019 was $120,000. Okay, now this first part over here is, would the contingent shares have to be considered in Windsor's 2019 earnings per share computations? And the answer that they're giving is yes, right? And they're taking the position, right, that over here, that they would need to be included. They would need to be included because they're already meeting the income threshold. However, there could be counter arguments to that. If there is a track record, meaning that over here, if for 2019 was 120, but 2018 or 2017 was like 40 or 50,000 per year, and the amount was somewhat of a fluke, you could be arguing that maybe they shouldn't be. Okay, so you have to look at all the different facts and circumstances. But KISO is kind of saying like, yeah, man, because over here they're achieving it, so therefore you should be including it in the earnings per share computations. Okay, assume the same facts except that 10,000 shares are contingent on Holiday's achieving net income of 130,000 in 2020. Would the contingent shares be considered earnings per share computations for 2019? So I think the reason why this one here is that the income for 2020 is less than, so over here, if you have to make 110,000 or more, they've already met the threshold. So that's why the text is really saying, yeah, you've got to go through and include it. For this one here, though, because the amount is less than, right, the earnings level is not being attained. This is what, you know, the book is saying, you would not go through and include it, right? Just remember, a lot of these questions here are facts and circumstances. This is really here, and the purpose of these exercises are really to kind of get you thinking like a CPA, to be thinking like an accountant, right? That's really kind of like my goal for you in terms of going through and doing these different types of problems and exercises. Okay, now let's take a look at exercise 1628. Okay, Howlett Corporation earned $360,000 during a period when it had an average of 100,000 shares of common stock outstanding. The common stock was sold at an average market price of 15 per share during the period. Also outstanding were 15,000 warrants that could be exercised to purchase one share of stock for $10 for each warrant exercise, right? So if I'm basically the owner of these warrants, I'm getting really excited, right? My strike price on the warrants is 10, the stock is selling at 15. So are these warrants in the money, right? Let's kind of go through and see, right? Are these warrants in the money? Okay. And the answer to this is yes. The exercise price of 10, right, is less than the market price of 15. Options are in the money, and we're going to call this, or basically here is the warrants. Okay. So warrants, stock options, kind of the same thing, but warrants are typically attached to a different type of instrument, like a debt financing, whereas options are typically given to different employees. This is if the company is actually going through and issuing them. So right over here, the exercise price of 10 is less than the market price, so the warrants are in the money. So what we're going to go through and do now for these warrants is we're going to kind of go through and take the same stance. Is that our warrants, right? How many warrants did we have? So we had 15,000 warrants. Okay, the market price is 15. This over here is at 10. So my profit is at $75,000. Now, if you remember from our last one over here, what I'm trying to go through and do is determine what it would be on a cashless exercise. So what I'm going to do here is I'm going to basically pull the same formula. Okay, so my market price per share is at 15. My profit is at 75,000. So basically right over here, the number of shares that would be issued on a cashless exercise would be 5,000 bucks. Excuse me, 5,000 shares, right? So if they were to do a cashless exercise, right? Why would they do this, right? So if over here, I can basically buy them for $10 per share. If I go through and I do a cashless exercise, basically the value of these is 75,000. I divide this by the market price per share and I get 5,000 warrants that should be issued. Okay, so the warrants are diluted because the exercise price is below the market price. Basic earnings per share. This is going to be 360,000 divided by 100,000, or this is going to be $3.60. Okay. Now, in terms of the other part of this, so EPS diluted, and again, this right here is my net income. Okay, so my diluted is going to be my net income, and it's going to be my weighted average shares outstanding plus my dilutive shares. So in this case, this is going to be 360,000. The bottom is going to be 100,000 plus the 5,000 over here that I just calculated. So right over here, this is going to be 105,000 divided by 360. Or over here, this is going to give us a diluted earnings per share of $3.43. Remember, the dilutive amount has to be less than the basic amount. If your dilutive amount is higher than basic, it is anti-dilutive and we have a problem. So that's what you want to kind of go through and make sure you do this. So again, big lesson from this is about cashless exercises. And we're going to use that cashless exercise kind of concept to help us determine the amount of dilutive shares that are going to be issued as a result if we have any kind of options or warrants. So I want to thank you for watching today, and I look forward. I want to also thank Wiley as well for allowing me to do this. Thank you, Wiley. Please don't forget to like and subscribe. If you want solutions to other questions in the text, feel free to send me a message. Look forward to seeing you on the next video. Have a great one.